set up to fully combat what was going on. They got them up ad hoc and then eventually improved their performance. This time they knew what to do, and they had those facilities and those mechanisms set up, and they acted really, really quickly. They flooded the financial markets with liquidity, and they've prevented a broader financial crisis that would have stemmed from the pandemic. That has helped keep us from falling further, and has put us on a footing to bounce back even stronger once we get past the virus. The other side of that is the fiscal side. Congress and the administration, through the first three phases of legislation, the bills that were passed, especially the CARES Act, the phase 3 legislation, has done a really good job of getting aid to those in need. So I'm thinking chiefly of the $1,200 per person pandemic relief payments, the extra $600 per week of unemployment benefits that ran through the end of July, and then the PPP program, the loans to small businesses to meet their payroll and their other overhead expenses. I think you combine all those things together, and what you have is a very effective response that has really prevented this from being a much bigger crisis. It also, this will come through as I go forward. It also means I think we're in pretty good shape if we can get past the virus. I think we're going to stay where we are right now, which is the economy is doing okay, given where we've been. But we're not going to see real big jumps up or fall back down. We're going to kind of continue as we're going right now. And then once we get past the virus, we're in pretty good shape. The one big caveat is that I don't know that any of the stuff I've talked about holds should we have a secondary lockdown. We made it through the first one. The economy is in okay shape. I don't see it falling off, but if we are forced to have a lockdown again, all bets are off. I don't know that we can respond in the same way that we have so far. So again, the good news is that the economy is growing again, and it will continue to follow the path of the virus. As I go through, I'm gonna share my screen in a second, and hopefully you can see some of the charts I prepared. Keep in mind that one of the other thing to watch when economic data comes out in the coming months is the difference in rates of change from month to month and the levels of those economic data. So this really comes into play when it comes to the job market, and it comes in with the size of the economy, the GDP. So we're likely to get record high levels of growth over months, but we had a really, really steep fall. And so it's going to take us a while to get back to the level we had before the recession. So you really need both parts of the data to really get a full understanding of what is going on. So with that, that's kind of the high level stuff that I wanted to hit on. I'm going to now share my screen, and hopefully you can see the data that I will be going through should help to drive home the higher level themes that I've just walked through. There we go. Okay, so hopefully you're seeing the slide deck now, and I'll walk through this, and then I will leave plenty of time for questions and answers. So back when all this started, my boss and a few others at the chamber asked, "Hey, do you have like a real-time measure of what's going on in the economy right now? Can you tell us like what's happening today?" This would be like March 15th, 16th, 17th. Are we falling off a cliff? And I said, that doesn't really exist, because if it did, that person would be a real-time investor in some way. But to help fill that gap, to the real-time, everyone wants real-time data now. Some researchers from where are they from? Harvard, the New York Fed, and the Dallas Fed put together, as best they can, a real-time measure of what's happening in the economy right now. And what this is it's 10 different variables that are 10 different economic data points that come out each month. And they put them together in an index to kind of give that overall view. So these are things like rail traffic, freight traffic, gas sales, tax withholding, staffing levels, same-store retail sales, unemployment claims, and a few others, and put them all together. And February, we're in pretty good shape. In fact, the economy was doing pretty well right into the middle of March, right until the great pause, as I call it, that started on March 13th began. We fall off a cliff in late March and into April, and then slowly start climbing back ever since late April, early March. And we're slowly getting back a better level. But we're still a long way off, as you can see, from where we were before the pandemic. That's one of the other themes here, is that we're doing well, but we still have a long way to go to get to full recovery. Interesting. So this is a relatively new real-time measure, but they cast the data back to through the Great Recession from 2007 to 2009. And as you can see by that dotted line, so there's two key things I want to show here. One is that our level where we are now, just today, just update this today, is just now back to the lowest level during the Great Recession, which is kind of incredible. That's how steep what we've gone through. Back when I said it's not hyperbolic to compare this to the Great Depression and Great Recession, this is why. We fell a heck of a lot further than we did during the Great Recession. However, look at the duration. We're talking a couple years back during 2007, 2009. Here's just a few short months. So the duration's a lot different, even though the severity is greater. Another data point that just came out, and I put this one at the top for two reasons. This is consumer sentiment, consumer confidence measured by the University of Michigan. I put this up here for two reasons. One is consumer confidence matters a great deal. The more consumers are confident about the economy, the more likely they are to spend, the stronger economic growth you get. It's pretty straightforward, pretty common sense. So it's an important measure. This has just been updated today for October. It's an initial reading from the University of Michigan. But I also put it here because it has that nice pattern I talked about of the virus driving the economy. So if you look back again, February, economy is doing pretty well. Really, given all things considered, it's in pretty strong condition. The pandemic strikes, it falls off a cliff, consumer sentiment does, which mirrors the economy. So we have a really bad March, really bad April. Things get a little better in May, but still pretty bad. Then the virus starts to recede in June and consumer confidence ticks back up. Then we get the surge in cases in the South and in the West in late June and into July, and consumer confidence dips. Cases then begin to subside again in August and into September, and consumer confidence begin rising again. Now, this is an early reading. We just got it, like I said today. It's a slightly higher reading in October than for September. They'll revise this and give another reading at the end of the month. It's probably going to be right around there. If you think about, again, if it's the virus driving this, it's probably that we're seeing tick up. So I don't see a lot of improvement here. That could change. But again, the pattern really shows that the virus is what determines economic activity right now. The other thing is that the levels again. So we've had good rates versus levels. We've had good rates of improvement on consumer confidence, consumer sentiment, but the levels. Look at the dotted line. It's significantly lower than where we were prior to the pandemic hitting. This is interesting because this is University of Michigan breaks this out by what consumers are feeling about the economy right now compared to what they feel about the future. Now, the future matters a great deal because how you feel about the future of the economy really comes down to like how you feel about your income and your job status. And if you're going to make a big ticket purchase, something like a home, a car, appliances, big ticket electronic items, things that often need finance, you need to feel like you're going to be able to make those payments a few months down the line. And interestingly, future expectations have been rising more sharply than current sentiment, and that applies for today as well. Consumers' future expectations jumped 3 percentage points, or three index points. The current situation fell. It's actually the future expectations. The overall reading is an average of these two. It's actually the future expectations that are driving the increase in consumer sentiment. So what that tells me is that consumers are now looking past the recession or past the virus. So they know that for the time being, the virus is coming back. We're getting in the winter months. It's going to be a rough couple months for sure when it comes to virus levels, but they can see the end of this. They see the light at the end of the tunnel. Maybe that means they're expecting a vaccine of some kind or a treatment that allows us to go back closer to normal, or whatever it is they're seeing. But the improvement of future expectations is really, really, it's encouraging, and I hope to see that trend continue. The job market is been one area that's been very difficult to gauge. So there's two things that we look at. One is unemployment claims. They'll come out each week, and they've been on the I would usually have a chart in here about initial unemployment claims, but the data is so suspect that I just took it out because we're getting this week, yesterday, we got a reading of 900,000 initial claims for unemployment. It seems implausibly high for a lot of reasons, but it has come down a whole lot. We had almost 7 million people claim unemployment in 1 week back in late March, and that level has come way down. But states' unemployment systems are overwhelmed, and they're still overwhelmed going back to March and April, trying to work through backlogs of claims. So that's skewed the initial claims data. This, though, is kind of, I think, moves past that issue. This is continuing claims. So this is people who claimed unemployment and then have come off because conceivably they might have run out of benefits, but hopefully more likely that they are now going back to work. And the continuing claims really spiked in April and May, and it's been coming down. The 4-week average of them have been coming down slowly and steadily week after week. And the pace of the drop has actually accelerated in the last couple of weeks. So that has been encouraging. It's still much too high. There's still a lot of people who are out of work. And that's what this data shows. This is the employment levels. This comes from the Bureau of Labor Statistics. This is the jobs report that comes out the first Friday of every month. So it came out 2 weeks ago, and for September. And what this shows, this is going to drive home the rates versus levels issue. But before I get into that further, I just want to point out that in February, so just a few months ago, it feels like a lifetime ago, but it's just a few months ago, the economy had 152.4 million jobs. It took from June of 2009 until that point, so almost 11 full years of growth. It's the longest economic expansion in post-World War II history to get to that many jobs in the economy. It takes a long time, a long period of growth to get to where you have that many jobs, and we were adding jobs for those at the lowest end of the skills scale. So lowest income, which lines up pretty much with lower end of the income scale. Those were the jobs. That's where the jobs were being created, and that was boosting incomes at those levels higher than anyone else. So the lowest skilled workers, the lowest earning workers, were getting the highest wage growth back in February. Unfortunately, the pandemic hits, and in March and in April, we lose over 22 million jobs. So just in basically a month span, we lost 22.1 million jobs. It's just, hopefully we never top that. But what that job loss did was it wiped out that 11 years of gains. These job losses have been heavily for the lower skilled workers, and all that progress, unfortunately, has been wiped out, and it will take another long period of economic expansion to get back to where we were. It's a really unfortunate side effect. But that aside, we've lost these 22 million jobs in March and April, and then in May, June, July, August, and September, so 5 consecutive months, now we've had job growth. That's very good news. In fact, we've had in actually every month up until September, it would have been record high job creation prior to the pandemic. So in May, we added, I think it was like 2.8 million jobs, 2.7 million jobs. Then in June, it was like 4.8 million jobs, which will probably always be a record. In July and August, it was 1.5 million for both months. And then in September, it was 661,000. So again, really good month-to-month job growth. But if you look at the red part of the chart there in September, there are still more than 10.7 million fewer jobs in the economy than there were just 7 months ago. So we have a long way to go to get back to where we were. Unfortunately, I think we'll keep adding jobs. We're just not going to add them at the rate we had in May, June, July, in August. It's going to be closer to the September rate, which means that's going to take a longer time to work off that gap. And we're talking years to work that gap off, unfortunately. I should point out that this is employment levels. This is the total number of jobs in the economy. This is not the unemployment rate, which is calculated separately. That's going to fall. That's going to fall more rapidly. We'll probably get back around 5% in next year, late next year. That's good. That will be a good sign. But the total number of jobs is going to take a long time to get back to where we were. So now switching over to economic growth, to GDP. Again, as I talked about earlier, the economy is doing pretty well in the early part of the year. And we had grown about 2% in 2019, probably going to grow about that in the first quarter before the pandemic hit. There were a couple headwinds. These are quaint to think about now, but back then, the Boeing had shut down production of the 737 MAX. That was going to cause a little bit of drag on economic growth in the first quarter. And there was this virus raging in China that was creating issues with the supply chain for businesses across the economy, but it was also creating big issues in the shipping and delivery issues on the West Coast. That was going to create a drag too, but we probably would have made that back up. So we're still growing at like 2% until like right into the middle of March. We get the great pause starting on the March 13th. So just 2 weeks of the quarter shut down ends up with a 5% reduction, contraction in the size of the economy in the first quarter. The great pause continues into April and into May, in some parts of the country, June and beyond. That's enough to get a 31.4% contraction of the economy in the second quarter. That is a record. The previous record was in 1958, and it was a 10% quarterly contraction. Interestingly enough, that was also caused by a pandemic. That was caused by the flu pandemic of 1958. So we have that record contraction, which is 10% was the previous record. We beat it by threefold. So that, again, that when I said this is not hyperbolic to compare what we've gone through to major economic crashes, this is why I said that. Before I go forward, I do want to point out that these are what are known as annualized estimates. This is just how the data is presented. It gets a little confusing. It's not confusing when it's normal times. It's confusing in a situation like this. We did not lose a third of the economy in the second quarter, fortunately. What it says is that if the economy contracted by that much for 4 consecutive quarters, so basically on an annual basis, then we would have lost a third of the economy over the course of a year. So you basically just divide that by 4. So it's like 9 point something percent was lost in the second quarter. Still would have been an enormous amount, but just keep that in mind when you hear this data reported, that it's usually on an annualized basis. And again, it is a little bit confusing. It takes some getting used to. So the flip side of having a significant contraction like that is that that it's over, which is really good. The contraction is over, and we are growing again. And we've had a record high contraction in the second quarter, and we should have a record high growth rate in the third quarter, which ended a couple weeks ago, ended on September 30th. This, I got some new estimates before we went on. This is actually tracking over 25% now. So the previous quarterly growth rate, record high, was in 1950. It was a 16.7% growth rate. We're going to eclipse that. We're going to be over 20 most likely. There's a range of the estimates that we follow. So you see Goldman Sachs thinks it's about 35%. JP Morgan updated theirs today. They're at 34%. The average is over 25%. So we're most likely to have a growth rate well in excess of 20% in the third quarter. That's really good news. So you can see the track of where we've been, growing at 2% in 2019, get the 5% contraction in the first quarter, all the way down to 31.4% contraction in the second quarter. Really good bounce back, over 25% in the third quarter. And then growth rate higher than where we were prior to the pandemic in the fourth quarter and into 2021, around 5% for both. That's good news. But again, this rates versus levels issue. On that trajectory, we still don't get back the level of economic activity, the size of the economy that we had prior to the pandemic until the fourth quarter of next year. It will take that long just to get back to where we were at the end of 2019. And this is because of the size of the contraction we've had. So even with those really high growth rates quarter after quarter, because of the size of the contraction we had in the second quarter, it's going to take a long time to get back there. Now this can and will move around a whole lot. I've done the numbers based on how the estimates of growth change, and I've had it hit that level in the middle of 2021. I've had it hit in 2022. The point wasn't to nail that exactly. I'm usually a little more optimistic. I think we'll probably get back there middle of next year. But the point wasn't to hit the date exactly. The point was to show just how big of a hole we dug, or was dug for us by the virus in the second quarter, and how long it takes to recover from a severe recession like that. So interesting enough, I alluded to this in the beginning, that income has not fallen. So usually, again, really a historic economic event, really high contraction in during March, April, and May. And you'd anticipate that with a enormous contraction like that, you'd have a really big drop in income and a commensurate drop in spending. Well, the drop in income didn't happen. In fact, we had a small drop in March, but then we have a record high monthly growth rate in April, over 12% growth in incomes just in 1 month. And then if you look between February of this year and August of this year, even though incomes have dropped every month except in July, we're still significantly above where we were in February. So incomes have been held up and are actually still in better condition than they were prior to the pandemic. How could this be? Well, a big reason is the support that, again, back to the support that the government provided, the pandemic relief payments of $1,200 per person, the extra $600 per week of unemployment benefits buoyed incomes in April, May, June, and July. So for 4 months, kept incomes elevated. So those ran out for the most part on July 31st. The administration has been trying to pay out extra unemployment benefits. It's unclear how that's working, but income did not collapse in August. So there's one other factor that has led to incomes staying steady or not plunging, is that the job growth I talked about a few minutes ago. Millions and millions of people going back to work. You go back to work, your income's getting closer back to where it was. That's keeping incomes up as well. So those three factors, the pandemic relief payments, the extra unemployment benefits, and then the return to work, is keeping income steady. Now, there's a big fear that the removal of government benefits will cause incomes to plummet and will cause consumption to fall. Now, incomes might fall pretty steeply in September. We'll see when we get that data in 2 weeks. It comes out at the end of the month. It's certainly possible. I've never been concerned about consumption falling a whole lot, because at the same time that we were having the pandemic and getting that government support, savings were skyrocketing. So starting in January and February, that's a more normal time, Americans saved roughly $100 billion per month. By April, that had grown to over $500 billion just in 1 month. And you see it's fallen each month since then. We're now down to over 200 billion in August, but that's still double the amount of monthly savings we had prior to the pandemic. So what this is saying is that Americans have saved up a lot of money over the last 5 months or so that they can use to support consumption in the coming months if they are not going back to work, if they need the support. So that money is out there to support consumption. The savings occurred for 2 reasons. One is that no matter if you were fortunate to keep working, like many of us were, you just can't spend, whether you're fortunate to keep working or you lost your job getting those benefits, those government benefits, you can't spend as you normally do during a pandemic. So all the things that we normally spend on when we're going to work, when we're traveling, when we're taking vacations, we haven't been able to do that, going to athletic events, whatever it is. Spending is you just cannot spend at the same level when you're at home a heck of a lot more than you used to be. So that some of this is forced savings, some of this is forward-lookingness by those who have been directly impacted and have lost their jobs. You received your the pandemic relief payment or extra unemployment benefits. Those unemployment benefits, just the extra $600 a week, in many cases were more than folks who were getting them were earning prior to the pandemic. So that just the extra $600 a week, which was on top of any state benefit, was more than their pre-pandemic wage. Fortunately, a lot of them were people getting those benefits were forward-looking and saved them, anticipating that the benefits might run out, as they have, and that their industry is one of those ones at the bottom of the K. They're not going to be able to fully back to work for the foreseeable future. So that money will help boost spending going forward. It can only last for so long, though. We're still going to need a phase 4 legislation that is targeted to those industries and those people who work in those industries to help them through until we can get more fully past the virus. For those working, this is good news that the pandemic has driven inflation down and wage growth has remained pretty strong. Wage growth is actually greater now than prior to the pandemic. There's a lot of noise in this data, so I don't spend a whole lot of time talking about this, but wages are growing pretty sharply for those who are working, and inflation being depressed. That means real buying power is increasing for workers. It's a good sign. You can buy more with what you're earning, and this is probably going to continue for a while because inflation is going to remain depressed until we can get past the pandemic. But here's what I want to get to in terms of income and savings. So there's been a big fear that consumption would fall off significantly. It's lower. Again, rates versus levels. It's the level here. The latest data in August is lower than it was. These are annualized numbers again. So this would be on an annualized basis. We're at $14.4 trillion of consumption. Before the pandemic hit, we were at 14.8. So roughly $500 billion below where we were. But we had dropped enormously off in March and April and May, or March and April. But then in May we had a good bounce back. That's a record high growth rate, 8.7% in May, and then another good month in June, and the growth rate in July and August is still pretty good. To see them growing at those rates, the levels are still down below where they were. I again anticipate seeing growth around 1%, probably lower than this as we go forward when it comes to consumption and spending, just because, again, I think we're going to continue on the path we're on right now until we can get past the virus. But this is really interesting. So well, the previous slide was just all consumption. So that's all spending on durable goods, non-durable goods, spending by businesses, on capital, on all sorts of things. This is just retail sales. This is retail sales inside at retail establishments, both in store and online. This is a V-shaped recovery. It fell off a cliff in March and April, huge declines, over 15% decline in April after an 8% decline in March. And then you get, again, a record growth rate in May, over 18%, strong growth in June again. And in June, it only took to June, so we're down below pre-pandemic levels in March, April, and May. So 3 months, fourth month is June, and we hit our pre-pandemic level in June. And it's grown every month since then. Another very strong month of retail sale growth in September, which just came out today, almost 2%. And we're well above pre-pandemic levels when it comes to retail sales and setting records every month. That's really good news. It means that, again, I think this is a couple things. One is people going back to work. It's the incomes are strong, savings, people are able to spend and are feeling okay about the economy. So this is really good news. This is probably the best economic data point right now is retail sales. Interestingly, so you would think that given where we are on just in the state of technology in the world, that it would be a lot of that retail sales would be occurring online, and it is. There's no doubt about that. But still, 85% of all retail sales, and I was surprised by this, still occur inside traditional brick and mortar stores. So still the vast majority of sales occur at retail establishments inside the stores. Only 15% is roughly online. Now that's been growing for a long time. It was growing from the end of the last recession was around 8%. It was over 11% of retail sales were online before the pandemic hit. It spiked to over 19% in April and May, and it's come down since then. This is going to be a really interesting story. One, just from a behavioral aspect for economists to study, like how did people change their habits and their behaviors in the face of improving technology and norms changing to shopping online, and then to the pandemic. So economists will be watching this. It'll be interesting, but this has a real impact on the real economy. And I'm thinking mostly of those retail stores that are losing business now. So if you're a retail establishment that doesn't really have an online presence, this is you're losing market share. But even those that do, I'm thinking of the businesses that used to anchor the shopping malls that we all used to go to. Those type of businesses have known for a long time that shopping is moving online and it's going to decrease their market share, and they were trying to adjust. I don't know if they're ever going to get there, but they had time. As you see, the move to online was kind of slow and steady. But then you have this big one-time shift, and the question would be, does the spike come all the way back down and come back to the trend it was on before, or is there a one-time structural shift? So it'll come down a little bit, and but not all the way, and continue going. And if that's the case, that means that all those businesses that were counting on some time to adjust have lost that time. And so that has three impacts. One is the business themselves. Are they going to be viable going forward? But then the secondary effects are for the commercial real estate that they occupy, the owners of those commercial real estate, again, the anchors of the malls. And then the third knock-on effect is the financiers of the commercial real estate and the businesses themselves. So it's going to be very interesting to watch. I don't know how it's going to play out. I think there's likely to be a lot of shifting to online, but I think a lot of us are going to be eager to get out of the house and go back to work and go back to shopping. So maybe it goes down, it goes further back down than we're anticipating. Hard to know for now, but it's definitely something to keep an eye on as we go forward. So I think I've used the time that we talked about, 35 to 40 minutes. So I can stop here and turn to questions. Oh, let me hit on two other things. Small business optimism is now at pre-pandemic levels. This is from the National Federation of Independent Businesses, NFIB. This came out earlier this week. Small businesses are feeling very strongly about the economy. That's really another really good sign. This is probably the second best piece of economic data we have, is that small businesses are optimistic about the prospects for the economy. And this is, again, it fell off a cliff. It's been bouncing around a little bit with the virus, but now it's at pre-pandemic level, another V-shaped recovery. And then manufacturing is another one. This is a flip of back in February, we were talking about a manufacturing recession, that it was services that were pulling the business side of the economy forward. Services were doing really well, manufacturing was doing poorly. That has reversed itself, like I talked about at the beginning. Manufacturing can operate in a socially distant pandemic world, and it's clearly doing that. This is manufacturing sentiment as measured by the Institute for Supply Management. So manufacturers are pretty bullish, and they're well above what they were feeling prior to the pandemic. So their prospects have done a 180. But services are also above their pre-pandemic levels, which is really interesting because services are the ones that are suffering, whether it's bars and restaurants or accommodation or any of the ones we talked about early on. I think what's going on here is that services are K-shaped so services are at the bottom of the K, but within services, there are some at the top and some at the bottom. The ones at the top are real estate, the financial service industry, things like that can still operate and largely are and are doing really well. The housing market is in really good shape. They're pulling the sentiment up for the service sector, while the ones that are at the bottom, they're already at the bottom and they're starting to do a little better because people are starting to go to restaurants, for instance, a little bit more. So they're feeling a little bit better, even though they're not back fully to where they were prior to the pandemic. So I think I lost track of time a little bit, but I think I'll stop there. I could keep going on, but please, questions, anything I've spoken about so far or anything that I didn't get to that you'd like to hear about, happy to answer those as well. Thank you.
Oh, it is on. If you have a question you'd like to ask, if you'd raise your hand, Alex and I'm sorry, I don't know his name and I should know his name. They have microphones at the back of the room and they'll bring you a microphone. Any questions? I see one at the back table there.
What do you suppose will be the impact when the foreclosure moratorium ends?
Thank you. That's a good question, and it's a concerning one. I think it will not be an immediate impact, and I think the reason why is that when this all started, my impression of the financial fallout was that if you were a landlord, whether it's for a family in a housing unit or for a business, it's in your interest to wait until those establishments or those families bounce back, to go back to work, the establishment opens again, because it's expensive and costly to remove somebody, to evict somebody, and then who's going to come into your retail establishment, and who's going to fill your vacant house when people are kind of stuck inside. So I think that will persist for a little while longer after the moratorium ends. I don't know how long that can persist. Again, the assistance from the Federal Reserve and the fiscal side from Congress and the administration have gone a long way to making this a less dire situation. So I think it wouldn't have been as bad if there had never been a moratorium at the beginning, which would have been kind of a disaster. But I don't know how long that can hold out afterwards. So I think if we can get past the virus by, say, the middle of late March, early April, I think it'll be okay. There'll certainly be some people who are evicted. But if we have a secondary lockdown, if we have a resurgence of the virus and no treatment or vaccine to suppress it, then things could get pretty rough in that situation, because it will be that the tenants can't make the payments, the landlords can't make the mortgage payments, and we get those knock-on effects of the cascading effects I talked about earlier that haven't occurred yet.
Any other questions in the room? Oh, over here.
I got to tell you, this does not sound like the world that I'm experiencing at all. I think that, can you talk about the folks that are doing fine or still doing fine, and the folks that weren't doing fine are not doing fine, and how that's been the split between those who are doing well and who aren't doing well already in our economy? I work for United Way, by the way, so I've seen the other side. I've dealt with the crisis fund all summer, where we've been helping people with rent and utilities, and most of those folks were already on the edge when we were able to provide some help. So I'm wondering just talk about that for me. Thank you.
Sure. So the point of the K-shaped recovery is that there are still those who are on the bottom, and they are going to they're in tough shape. So while I'm optimistic about where the economy is and will end up, there are certainly those who are in dire circumstances. There's no denying that, and that's why I was talking about the need for a phase 4 legislation from Congress. So I'm not optimistic that we're going to get that before the election. But what that package really needs to be doing is targeting aid to those who are broadly in need. Because again, while there are those who are on the top and doing well, they don't need assistance right now. It's the ones that are on the bottom who need support, and that goes for businesses and for individuals, and that's where the aid should be being targeted. So I don't want to minimize in any way the pain that exists out there, because I know it is considerable, and that's why I've been saying this. That's why the chamber's been saying this. We really need that phase 4 package, and I hope I made this clear that those who are struggling, whether it's again a business or a family, if you're in that situation, it's really hard to get out of it right now if you're working in a sector or an industry that can't operate. So I'm totally sympathetic to that, and I understand that I understand that is going on, and that's the nature of a K-shaped recovery, that you can have overall that the businesses that are at the top of it are doing well and well enough that the top line numbers look pretty good, but there is still significant suffering for those who are on the bottom of the K.
We can take one more question if we have one more in the room. This way, Alex. Oh, sorry, he went that way.
I was just curious as to how much you think the consumer sentiment and even the manufacturing sentiment is being either buoyed or tamped down by election expectations.
That's a really good question, because I forget which of those measures. One of them does measure. Oh, our own measure of Chamber has a small business index that it does with MetLife, and the election is a big factor of small businesses that are. It's a big factor that they're monitoring. I don't think that it's. I think it's something that they're concerned about, because they're clearly concerned about the policy implications of the election, and depending on which way it goes, what taxes and regulations and things that might fall on them starting next year. And so that does play in, and they're certainly watching it, and there's certainly heightened interest. But what those measures are looking at right now is the course of the economy in the next few months. And the election is not going to impact the economy right away. It's going to take a while for policy changes to be implemented. So I think that while they are tuned into it, they are not necessarily worried about it impacting their business right this second. That doesn't mean they don't worry about it in a year from now. They certainly do. That's why they have the heightened expectations. So I think and then that leads to another important point, which is that there are two sides to look at when it looks to kind of baking the election impact into forecasts. So on the stock market side, financial markets bake all information in immediately. A great synthesizer of information. I think they've pretty much priced in a Democratic sweep of a Biden presidency and a Democratic control of the Senate. And so they've priced that in, and they're looking at that. What they probably haven't priced in on the financial market side is the economic impact of the legislation that might come out of that. So energy legislation, like a carbon tax, which could be likely, tax increases, other major regulations. Think about the 8 years of the Obama administration. Like, what's Joe Biden going to do? He's going to dust off it's all in the budget. He's going to dust it off, put his name on it, and that's going to be the Biden agenda, things that weren't accomplished. So not sure the financial markets have factored that in yet, but they're also looking similarly. So the real economic effects actually on production and business activity, that takes a while. So even if you had a carbon tax that was passed next year, it's going to take a while for that to actually impact behavior and impact businesses. So I think it makes sense on both for businesses not to be so much worried about that yet, and for the market not to have necessarily priced it in as well. But both those things have to you have to look at both sides.
All right, thank you very much, Curtis. Next, we would like to welcome Mike Williams. Oh, you should clap for him.
Thank you.
Trying to keep us on track. I'd like to welcome Mike Williams, past chairman of the Chamber's Board of Directors, to moderate today's discussion.
Well, hello and good afternoon. So as y'all know, COVID has really impacted communities around the state, around the nation significantly. And if we're going to recover from this, we need to talk about how we're going to pivot towards recovery and things we need to do to make that recovery happen. So we've got a panel of business experts here. We've got, first of all, Sarah Fitzgerald. Sarah works for the Wyoming Business Council. She's Chief Strategy Officer. So I kind of was looking at the table here as I was sitting down there, and you're like on this nice big table by yourself with a mic. You kind of remind me of like a judge, presiding over your court. So you're going to be known as the Honorable Sarah Fitzgerald for the rest of the day. Okay. Yeah. And our second panelist is Rob Godby from the University of Wyoming. He's the acting associate dean of the Haub School of Environment and Natural Resources and an associate professor at the Department of Economics with University of Wyoming. So everybody wave at Rob. Wave. Okay, Rob, I did that so I could see how many people wave at the screen and how many people wave at the camera.
Right.
So you may need to adjust your comments accordingly.
So where did they wave to?
Well, it was about half and half.
Oh, awesome.
Maybe 2/3 to the screen. All right, so let's go ahead and jump into it. And Rob, let's start with you. If you wouldn't mind giving us, a few minutes, an overview of the Wyoming economy and how it might compare to what we're seeing nationally and what Curtis had to say for us.
Sure. So the first thing I'd say is, the national economy is very different from what Wyoming is experiencing for a couple different reasons. First of all is the virus. And that's going to continue. So the national experience with the virus, especially if you think about the news, has been far more serious in major population centers like New York City, in California, in places like Chicago. And because of that, they've seen far stronger reactions to that. Their economies were essentially closed down for a period of time. Whereas here in Wyoming, until recently, we've seen very low virus loads. Most of us didn't know somebody and still don't know anybody who's, say, for example, died from COVID. And we didn't really have a full shutdown. We had a partial shutdown. Certainly we had a slowdown, but we were able to get by without having one of the few states to have an actual shutdown. So we were not disallowed from engaging in day-to-day activity. And to some degree, that may have led us to a bit of a complacence And the question is, what's going to happen going forward? So the virus really is in control of this economy, and that has had effects on us, both the external effect, what it's done to energy markets, which I'll come back to in a second, what it's done to tourism, which ironically has looked to be a boon in the later half of the summer, what it's done to our hospitality sector, and then just what it's done to our everyday routine. There's those external effects, and then there's the internal effects. So I'm in complete agreement with Curtis that, first of all, the virus is in control of this thing, and really what happens next with the virus is really going to determine what happens. And this is unlike any other recession we've had. We've got indicators that are all over the board. Stock market is at record highs, and yet we are at some of the highest unemployment levels we've ever seen, and certainly the highest level of unemployment as opposed to the unemployment rate that we've ever seen. Other indicators are very bad, as one of the questioners pointed out. For some people, this literally is a depression, and it's very difficult to get out of this. There's an old quote that Harry Truman said that a recession is when your neighbor loses your job, and a depression is when you lose your job. Many people are still in that depression. So that's the first thing. The second thing that I'd say is that, and I am less confident than Curtis was on this, I think what the government does next and how it supports the economy is essential. I really do think that we're kind of in a state of kind of suspended animation here. We haven't really reacted to the effects of what's gone on in the economy, in part because the government stepped in so effectively and so quickly to support people's incomes and spending. And what I am concerned about is how the bottom may drop out of that if we don't see continued relief to the economy. And this is really important. Unlike in 2008, 2009, when we talked about the government stepping in to provide stimulus to restart the economy, in this situation, this was not meant to be stimulus. This was meant to be relief. Basically, what we did was we avoided, kind of the food lines and things like that you see out of the 1930s by sending checks to people's houses to make sure that a lot of people still had an income coming in. And when you combine that with an expectation that a lot of people had that their job layoff was only temporary, which many of them were told, spending kind of continued where it could, more or less as it did before, or it recovered as soon as it could. I am really concerned about going forward, though, if we don't get that government support, what that will do to the national economy and how it'll affect us. So the two critical things to me are what happens with the virus. And I think we also kind of have a sense of optimism on that virus, right? First of all, we didn't see it in Wyoming really hit us that hard. And then we've been told a lot, well, there's a vaccine coming. But, the reality of the vaccine coming, and there's been, reports from the CDC and others that have come out, we're unlikely to see a vaccine before sometime early in the new year. And then once that vaccine comes, it will take a long time to eradicate the virus, to vaccinate everybody. And what people are talking about is now not until the following year, possibly January of 22, before we have a fully vaccinated population, which means that people reacting to the virus, avoiding things like travel, which is really important to Wyoming, may continue. And that is why I go back to the fact that we are probably going to continue to need federal relief to prop up the economy. And the stronger the national economy is, the stronger the Wyoming economy will be. So that's where I kind of look at the COVID recession. But I would also say in Wyoming, we are about to get the double whammy of this. We have an energy economy that was already looking at a recession coming. Declines in coal and natural gas production were well underway, and they were accelerating. And that was before COVID. And we were really looking at an expectation of a recession beginning in Wyoming in the next year or so. This was back in February, depending on how oil did. Well, we all know how oil did. once COVID hit. It got hammered. And so now what we're looking at is really a really massive reduction in our energy sector, which is a quarter of our economy. It's only about 6% of employment, but it's a quarter of our economy, and it's 50% of our state revenues. And that's pretty much a disaster. You know, oil had never declined by more than 10% in any single year going back to the 1980s. When we saw this in May, we thought it might decline by 40%. Now, the good news is it's only declined by somewhere between 15 and 20%, but that is still a gigantic decline. We are now at employment levels in the energy sector that we haven't seen since the late 1990s. We've lost a quarter of our employment in the energy sector. We've lost about 20% of our oil production. We've lost almost 30% of our coal production. And the problem is coal production is probably not going to come back. Natural gas production is kind of hanging on, but it's really automated, right? You drill those wells, the stuff comes out of the ground, and that's declining. The real concern there is we're not drilling anymore. And so while we're only down about 3-4% in natural gas right now, we're looking at about a 25% decline a year out from now, maybe more, because we're not drilling for natural gas. And the types of wells we drill, about 50% of the production goes away if you don't keep replacing the wells with new wells because of just the technology that's there. So we're looking at a longer term decline in energy that's really going to hit our state revenues. And of course, the largest employer in the state is government. And so unless we do something about state revenues, we're also going to be looking at continued sluggishness there. And then you can't miss the tourism economy. Now this summer, we started off really slow and the national parks are down, for example, but the good news was people wanted to go places where they just wanted to do something. And then they went to places that seemed safe, and Wyoming was that. And so we actually had some almost record-setting numbers by the end of the summer in the national parks. And in fact, for September, we're ahead of last year's numbers. But what's going to happen if the national economy really does slow down and there's no longer those payments in people's pockets that people have been counting on from the government, and the temporary layoff turns into a permanent layoff? That is a real concern. So our tourism sector has actually been an unexpected strong point. It's usually far more cyclical and more dependent on the national economy. And when the national economy goes down, it goes down too. But in effect, what happened was people got tired of the pandemic and they went to a place they thought they could be safe, and they went to the only place they could go because they don't want to fly. On the hospitality side, boy, we're still suffering. We're down about 20% in employment. Now, the good news is it was down about 40%. In the midst of the pandemic, it's recovered to about 20%. But again, total employment in hospitality and leisure is back where we were in 2000. So our two strongest pillars of our private economy are really hurting. One is very dependent on what happens nationally, and the other is really in a structural decline. That's our fossil fuel dependence. The rigs are probably not coming back to the state for quite a while, which means our energy production is going to continue to fall as the existing wells decline in their output. Coal is falling, people know that. And then finally, government is really going to struggle either until we find new sources of revenue or we somehow replace that. So it's a pretty tough time right now. But it is kind of a weird two-speed economy where we don't really see the damage that's been done, because in some sense, we're kind of being artificially supported by the amount of relief that's been pumped into the national economy and by extension, Wyoming's.
Thanks, Rob. Really appreciate that. So hang on, we'll be back to you. Let's move on to Sarah for a few minutes, and let's kind of talk about, the future a little bit of the past, but a little bit of the future, and what the Wyoming Business Council is doing to help us diversify our economy and bring in new businesses. So what are you seeing in Wyoming from your lens, and maybe more specifically Laramie County?
Yeah, definitely. Can everybody hear me? Okay. So I think I'm going to just bring it a little bit, maybe kind of more to the micro level than what Rob talked about. what the Business Council has been doing since COVID-19 hit in March is administering the business relief programs. And so what we've gotten our lens, if you will, is we're listening to businesses, we're hearing what businesses are saying, and we're talking to more businesses than we've ever had the chance to interact with in the past. And in fact, we've distributed $301 million across the state as of today to 5,600 businesses. And that's supporting about 32,000 jobs. And so what Rob said and what Curtis said about that CARES Act money is a lot of it's coming through the Business Council, and it certainly is. There's a lot of money in the economy. Laramie County accounts for about 30% of that. $32 million of business relief program funds have been distributed to about a little fewer than 1,000 companies and businesses in Laramie County. On a per capita basis for Laramie County, it's pretty much kind of middle of the road. Now the bigger counties like Laramie County and Natrona County have a little bit less business relief program funding compared to the smaller counties, just because some of the smaller counties have 2,000 people in them and things like that. So, but pretty middle of the road in terms of just amount of stimulus money or relief money out into the economy. When it comes to the K-shaped recession that Curtis talked about, we actually do see a lot of evidence for that in the funds that we've distributed. By a long way, restaurants and the hospitality, restaurants and the restaurants, coffee shops, bars, that kind of thing are by far the biggest receivers of our business relief program funds. And it's hard to kind of make conclusions from the funds that are distributed through the Business Council and how much suffering is going on in an industry, because there's a lot of other things that go into that. But I think that's kind of a strong piece of evidence that we do see those kind of those industries that are kind of on the bottom of the K. We do pretty much see that reflected. And even in the hospitality business, we do see those businesses in lodging. They are incurring losses and have incurred a significant amount of losses since the beginning of the pandemic. Even though, as Rob said, they are kind of starting to come back. Outside of the business relief programs, we do see some kind of forward-looking indicators that that kind of top part of the K, the industries that are doing well, manufacturing, technology. We do see some indicators that those industries are looking toward the future and looking for and planning. So we have gotten more interest in Wyoming from manufacturing companies wanting to move here or expand here than ever before during the pandemic. And so and we've also seen the same kind of thing from technology companies looking to move out of places like San Francisco, like Dallas, like New York City, to come and move their company to Wyoming, come start their company in Wyoming. And so we see, that to me, I think implies that those industries are better able to plan for the future, better able to kind of look beyond to past tomorrow, rather than kind of just really trying to survive. And so I do see kind of that K-shape coming out in the evidence that we see through the lens of the businesses that we talk to at the Business Council. And really importantly about that, I think, and a reason for Wyoming to be very optimistic is, like Rob said, we have not suffered from the pandemic as much as most of the country has. And so Wyoming is a bright spot, I think, in the overall economy, and businesses from all over are recognizing that. And so even though, this pandemic has been terrible and awful, and there have been some really dire outcomes because of it, there's a lot of reason to be optimistic still.
Thanks, appreciate that. So we only have a few minutes left, so I want to just address one topic. And Sarah, maybe you can start with us, and then we'll go to Rob and see what his thoughts are. And thanks to Bob Jensen for the question. Everybody knows Bobby's a celebrity around here, but it really has to do with the future of Wyoming County and the future of Wyoming. And I think that we have some really good opportunities in the next few years with 3 specific industries. And what I would like to know from you is how can they integrate together, and how can we leverage them to build a future around these industries that will last and diversify our economy. So the 3 things, or the 3 topics, are GBSD, obviously is a huge one. And then we have the growing wind industry and other renewables. And then we also have the tech industry. And that is kind of feels like it's ready to take off here. So how do we take advantage of those 3 things together and apart to give us a better future here?
Yeah, awesome question. I think there are a few things that kind of tie those things together. First is just, the leadership that it's taken to get us from 0 to 1 in those sectors, or from very little to a little bit more in those sectors. So with GBSD, just huge shout out to the Chamber and to Dale for the leadership that they've done there. That's taken a lot of work to get Cheyenne to where it is now. And when it comes to tech, the leadership of the legislature and others in the blockchain legislation that's been passed over the past few years is huge. And of course, in renewables, that's more driven by the private sector. But one of the things that I think that we need to really make sure of is that even though we've kind of gotten to that place and we've kind of gotten some wins, right? So we've gotten over the line of creating blockchain legislation, and we are pioneering that space across the country and getting huge accolades for it from the financial industry in New York, from VC in San Francisco. When it comes to the GBSD, we're first. That's a huge win. But what we can't do is rest. And what we have to do is get behind the leaders who have started those huge wins, and get behind Dale and support him together. At the state level, at the community college level, and really make sure that we're collaborating to do that. The other thing that those industries have in common is workforce. And I think probably many of you in the room have that challenge. Attracting and keeping our best and our brightest in Wyoming is I think something that we should all really focus on. And I really want to kind of change the narrative around that, and I think in the same way that we talk about diversification in Wyoming, diversification is important, but, all of you are a diverse economy sitting in the room. We have a lot of good things going for us, not only in the business community, but also in what we have to offer here for workforce, for graduates coming out of UW, for graduates coming out of the Colorado School of Mines, for graduates from everywhere. And that's what I think we kind of need to double down in tech, in aerospace and defense. Those require a lot of knowledge workforce. And so we really need to double down on that. I'm going to take an opportunity to just plug a little bit a marketing campaign that we actually just launched in LA and Denver. It's called Why Relocate, #WhyRelocate, and it's ties in with the That's Why campaigns that are already in those markets. We launched that a couple of weeks ago. We've already gotten almost 1,000 leads from people who are either looking to move to Wyoming to work remotely, to move to Wyoming to find a job here, or to move to Wyoming to start a business. And that's a huge bright spot, you guys. This is a really exciting time for Wyoming. because of that. So that workforce piece is a huge, huge piece. And I'm going to be reaching out to folks at the chamber to make sure that we can involve your businesses in that, so that when folks tell us, hey, I want to move to Wyoming, I want to look for a job there, so that we can hook them up with you guys. But I think the renewable energy piece is also very important, and that's a critical driver of that technology piece. Technology, data, the computing power that's needed to do all of the cool things that we want to do with crypto and blockchain and with aerospace and defense, that requires a lot of power. And guess what? Those companies want renewable energy. And so I think when it comes to that, it's all about really listening to your customers, and not just the first customer, not just the data centers, not just the computing, but their customers. And it's all about finding that kind of market fit. And I think that we can encourage all of the folks working on that to really listen to what the needs are there. And I think sometimes we aren't really good at that, and we tend to kind of think, well, here's what we have here, and how do we make that work for our customers? But that's not going to work. We need to say, what do you need, customers, and how can we work for you? So, yeah.
Thank you. Rob, do you have anything to add to that subject?
Well, a couple things. So I think we have to, this is the Cheyenne Chamber of Commerce, so I totally respect and appreciate the local nature of this. But I think as a state, we have to think a little more broadly, and that we have some pretty big challenges. And Sarah talked in a great way about where potential opportunities are. I think we have a huge opportunity in renewables. We're certainly hopeful that we can move towards higher technology. We've heard a lot about blockchain, but I'd be careful. So just to give you a little sense of this, and maybe to make sure that, we don't confuse the local economy, the very local economy, with the statewide economy. The very first thing you said, GBSD, I'm like, wait a sec, what the hell is that? Sorry, didn't mean heck. But outside of Laramie County, GBSD is not getting talked a lot. I didn't even know what it was. Oh yeah, defense, of course. But the point I'm making is statewide, we've got to think a little bit wider. And a big concern I have right now is attracting businesses and ensuring that we have the public services that will keep those businesses thinking about coming to Wyoming. And that requires a good education system, a good health system, strong and viable infrastructure that's in good repair. What does that all require? It requires government revenue. And until we talk about revenue, and I know people are tired of hearing about this, but 50% of our state revenue has come from energy. That fossil energy is going away. It's not going to be easily replaced. And unfortunately, it means that we're going to have some really hard conversations about what we're willing to pay for and at what level. And until we have that kind of conversation about revenues, I think we're going to be challenged, because you have to remember that the largest sector in the state is actually government. And so in order to kind of, looking to the future and looking long term, I think Wyoming has a lot to offer. The work and play kind of attraction that Wyoming has, especially to those people on the upper leg of the K, is very important. And I think it's what the Business Council is taking advantage of. We really have something to offer people, and some very high income opportunities may come here, and it may keep more people in the state. But we have to think about also the regular economy, and where is that going, and how are we going to support that, and how are we going to support the public services that are necessary to support all parts of the economy. And so I have real concerns about that in the near term. And we have some tough decisions to make, because those near-term decisions are going to, in turn, determine how attractive we are to people outside of the state. We can't just continue to offer ourselves as the low tax place to come. If that were a viable economic development strategy, we wouldn't have a problem with economic development because we're basically the lowest tax place in the country. We really have to think about how we attract people with good public services, good education, and support those types of people that may want to come here, that support those new industries that will replace the older ones that may begin to phase out over time.
Thanks, Rob. So it's 1:07, and I was going to start asking about budget cuts and the impact of those on local communities, but I think we won't have time for that discussion, unless y'all want to stay all afternoon. But
I can say
anyway.
something super short about that.
Sure.
And I feel like I'm like sunshine and Rob is like a rain cloud. So, sorry, Rob. But I'm mostly sunny on budget cuts even, and I am employed by that biggest chunk of the employer of the economy. I think there's budget cuts are real and budget cuts hurt, and we at the Business Council have been directly affected by budget cuts in very real and personal ways. But there's again just a silver lining that is much bigger than the cloud here, because what that's forced us to do is work more collaboratively with other state agencies, with the private sector, the University of Wyoming, than we ever have had to before. And there's a lot more that comes from that than just cut budgets and efficiencies. There's synergy that comes from that, to use a buzzword. But there's, and Rob kind of alluded to it, the same thing that attracts businesses to Wyoming is the same thing that attracts workforce to Wyoming, is the same thing that attracts tourists to Wyoming. And so the Why Relocate campaign that I just talked about, that's a collaboration between the Wyoming Office of Tourism and the Wyoming Department of Workforce Services and the Business Council. And that's not just efficient, that's just better, and that kind of thing is happening all across the board. We're working with UW a lot more closely now. And so budget cuts are bad, and budget cuts are going to get a lot worse before they get better. To Rob's point, that's absolutely true. But I think, again, there's reason for optimism there as well.
Thank you, guys. Appreciate it. And we'll just stop there.
I think all I have to do is tell you thank you. But on behalf of the Greater Cheyenne Chamber of Commerce, we would like to sincerely thank you for attending the 2020 Economic Forecast Luncheon. And thank you so much to our panelists and moderator, Mike Williams. We're celebrating community and collaboration at the final event of Business Month, the Big Picture Annual Awards, presented by Halliday Motors Auto Group on Friday, October 30th. So pre-Halloween. If you have not registered and want to attend, let the chamber staff know. And thank you all again for coming, and we look forward to seeing you again next year at this Economic Forecast Luncheon. Thank you.